Hello traders and welcome to Liquidity Tech Solutions. So this is ICT mentorship and we are on liquidity. So in the previous video we talked about liquidity pool and also liquidity void. And today we're going to talk about fair value gaps as a liquidity, engineering liquidity and liquidity injection. So if you're new to this channel, here we trade and we learn Forex as well. So kindly subscribe, hit the notification bell so you don't miss anything because we give signals as well, trading signals. So let's get started. For liquidity, as I said, liquidity is money, and institutional traders always take out retailers out of the market because they place their buy stops and sell stops. So anytime retailers buy, institutional traders will sell, and anytime retailers sell, institutional traders will buy. So that is how it works. So if you haven't watched it, kindly go to the mentorship, ICT mentorship playlist below in the description and check out the video there. So let's go to fair value gaps. A fair value gap is a range in price delivery where one of the sides of the market liquidity is offered and typically is confirmed with a liquidity void on the lower time frame. So price can actually gap to create a literal vacuum of trading that's posting an actual price gap. So fair value gaps. I also did a video on fair value gaps. Okay, so go to the description. The link will be below. So as you know, fair value gaps, that the first candlestick and the third candlestick, there should be a gap, and then we expect price to tap into that gap. So that is fair value gap. So looking at this diagram right here, you can see there's a fair value gap after this strong bearish candle. So the first candle, the second candle, and the third candle, which is the green, there is a gap between the wick of the first candle and the third candle. So that is a gap. Well, that's what we call a fair value gap, and we expect price to always come and tap into that fair value gap. So in the same place, you can clearly see that the gap from a higher time frame and on a lower time frame, this is how it looks, and price came all the way to tap into that gap which has been filled. And so anytime there's a fair value gap, meaning there's a lot of money or liquidity residing there, there are a lot of sell stops and buy stops residing at that gap, and then smart money will come with the banks to clear off all those buy stops and sell stops or stop losses which are residing there. So that is liquidity for fair value gap. We'll go to the charts to also identify real life real life um, liquidities, fair value gaps, and other ones we're going to look at. So looking at liquidity injection. Liquidity injection, is the Judas swing or a stop hands move that will take the stops, setting above previous swings high or below a previous swing low. So this is more or less like the liquidity pool, which I explained in the other video. So as you can see that we had this bullish trend from this diagram. We had this bullish trend where um where buy stops will be residing because retailers are going to be like, yeah, the market is going up, let us buy, let us buy. They're going to buy and put their stop losses around the side, and indeed the price then came, and as price failed to break, came here and failed to break, so there's going to be a resistance. So retailers are going to be that, all right, so now there's a breakout of the resistance, meaning this side is going to be a support. So they are going to keep on buy and put their stop losses right below this support. So right below this right below this support here, because they think here is a support. So after this breakout, they're going to put their stop losses right below, and then smart money comes in. So smart money comes in, push the markets down, take out their stop loss, and you can see we have a very long bearish movement to the downside. So many all stops, that is all buy stops, residing at that level are all taken. So vice versa for the sell stops as well. We'll also go to the charts to identify uh, these ones. Now let's see engineering liquidity. What is engineering liquidity? Engineering liquidity, so it is the false move after an Asian range consolidation that will validate trades to the direction of the overall trend and stop them in London or in New York before going to the intended direction. So London or New York sessions. I will explain that more further in let's see. So in order to avoid fake breakouts which are coming out of the Asian range, you have to make sure you understand the high time frame direction and other blocks. So when you see a double bottom or a double top, you just have to know that stops are sitting below or above them, and markets will, will take those stops before continuing to the intended direction. Alright, so we can clearly see from this diagram here that we had this strong, supports or demand zone right here. Price failed to break, and then all this is the engineering liquidity pair, the explanation, and I'll take you to the live trade. So liquidities will be residing at this level. Liquidities will be residing at this level, and then we have a very strong run up to the top with a double bottom formation formed on this demand zone, and had a run up to the top. So we're going to explain this, or you're going to understand this further when we move into the charts. So now let's go into the charts to identify all these liquidities we have explained now. So looking at fair value on a real time trade, you all know we are still holding this trade. Day traders give the signal and still holding it. So this is a real time, and I want to explain to you that all this I'm teaching, we apply them in our trades, in our live trades. Okay, so it's something useful you have to learn. So on the fair value gap, I have a video on fair value gap, and I explained that we can have about one or two or three fair value gaps lying, that is above a resistance, above a support, sorry. So you can see at this support zone we had this first fair value gap here. As you can see, this red um, red candle and this third green candle, the wicks doesn't match, so we had a gap here, and as well this green candle and this third candle right here, we have this long gap here, which is also a fair value gap. So we have two fair value gaps residing here, which are all liquidity, because sell stops are residing here. Okay, so and in the explanation I said that fair value gaps, price will go up or wherever and come back to tap into the fair value gap to take out liquidities and to take out retailers and sell stops that are residing below. So we can clearly see from here, after this run up to the side, so retailers are going to be like, oh yeah, the market is going to go up, so let us buy. They buy here at the zone where the mouse is. They buy there and put their stop loss right below. Now price comes, tap into and clears them out of the market. So you can see this is a fair value gap where money is residing, and now taps and clears them out of the market. Now the price went all the way up and now came down again, and retailers are going to be like, yeah, money is residing. So retailers are going to be like, yeah, the bears are in control. Let us sell, because there was a breakout here, which signifies a false breakout. Our retailers are going to sell, put their stop losses right here, and then the institutional traders come and place them out of the market. Price, the bears comes in again with this, strong momentum, bearish candles, breaks the support again. Retailers are going to sell, put their stop loss right here, and the institutional traders comes in again to take them out of the market. So this is what we call so from here where we started, that's explaining the fair value gap, liquidity injection right here. This is not liquidity. So we can clearly see that this zone drawn is a liquidity injection all in one trade. Now let's look for engineering liquidity. So for engineering liquidity, it is a false move after an ancient range consolidation. Okay, so let's see. We have some consolidations right here, which is an ancient range consolidation. And now there's a false, or this strong bearish candlestick that has broken out of the range. Okay, so since it broke out of the range, what are you going to expect? You're going to expect a sell or a bearish movement. So retailers are going to what? They're going to sell. They expect to sell, and then they're going to put their stop losses. Let's say right above the range. Okay, so they're going to put their stop losses here. Good, and then the institutional traders came all the way and took them out of the market. You can see now they are taking out of the market. Their stop losses are here, and now they are taking out of the market, and now the market went down again in their favor, but now their stop losses are taken, so retailers are gone out of the market. So this is how powerful smart money ICT concepts works out. Okay, so make sure you learn everything that I'm posting here. Subscribe to this channel, hit the notification bell, join the Telegram channel. We learn Forex, we trade Forex. So I hope this is helpful. If you like this video, kindly like, subscribe, hit the notification bell as well. Alright, thank you.